Welcome to the Breneman Blueprint Podcast. If you don't know by now, I'm your host, Drew Breneman. So for this week's episode, I have a change of pace for everybody. I'm going to be behind the mic as a guest. So last year, I joined Paul Thompson on his podcast, and I've gone on a number of podcasts, and this was one of my favorite conversations. He really just set me up so well with the questions he asked, where I remember listening back to it. I was flying to my friend's wedding, and I was going, wow, this really came out great. Which, to be honest, sometimes you think, okay, this came out okay, but not, I wish I gave a better answer there. And this was one of the ones where I remember thinking, okay, this is one of my better appearances. So I wanted to share it with everybody. The answers I gave, I thought were really precise. And then also, we just ran through so many interesting things real quickly. My career, what makes Breneman Capital special, why we invest in multifamily, what our strategy is, how we've created an edge for ourselves with our investments, some of my best deals. So anyways, without any further ado, here's the episode. Hope you enjoy it.
Are you ready to take control of your life and build your ideal future? Striving for financial independence and a clear plan of action. Do you feel you should be doing more with your investments? Look no further. Welcome to My Freedom Foundry with your guide, Paul David Thompson, who helps business owners forge their path to freedom. Strap in and get ready to level up your life.
Hello, welcome back to My Freedom Foundry. And today this is a bit of an interesting conversation I'm going to have with Drew because it follows along the path that I've recently moved to myself, and that's towards multifamily. And I was really reluctant to do that for a long time. Anybody listening to this knows that I've cut my teeth on single family, and Drew's going to walk me through just how smart and brilliant it was to move into multifamily. Isn't that right, Drew?
That's right. That's what I'm here for. Just back up your decision.
Yeah, that's really just confirmation bias that the decision I've made is worth it. Yeah.
So yeah. That's funny. So, no, it's just maybe a coincidence on the timing of the episode.
Yeah, that is kind of funny, isn't it? So I just read through a quick intro. People have a little sense of who you are, but I'd like to give you a chance live to tell the audience who you are, where you're from, and what do you do?
Yeah, Drew Breneman with Breneman Capital from the Milwaukee area, and then have been doing real estate investing since I was 19. I started an internet business, made some money doing that, and didn't want to, waste any time. Bought my first rental property when I was a freshman in college. A couple years later, I had bought 4 when I was in school. A couple years later, met an investor partner. The three of us, me, him, and his son, we bought about $100 million of property together. Did that for 9 years in Minneapolis and in Chicago, and then met another family, kind of similar scenario, bought another 100 or so million, all different product types, retail, multifamily, office, industrial. Worked for a little bit as a W-2 just to learn when the market was slow in 2008, 9, 10, 11, in different product types. So worked for office developer, retail developer, multifamily, just all 3 separate jobs. So I had a lot of experience, different product types, different markets. And then in the last 2 years, really kind of made a similar decision to you, if you will, where just want to specialize in multifamily and just specialize in a few markets. So and the markets we could get into too, but, I'm been in the Midwest my entire life, went to college there, only lived in the Midwest, and that's where I invested. And then I'd see all these people just crushing it in the Sun Belt, where we have really good deals here too, where, I think our average return on this realized deals, the ones we sold, is a 25% IRR. So we did well in the Midwest. Those are great returns. And that's not just over like a short time period either. That's like a average 5-year hold.
Sure.
But, people probably could have bought anything in like Phoenix in the same time, or in, Austin, Texas, and done just as well. So I'd rather, I get the trends behind me versus fighting the trends in these cities that aren't growing so much. So
that aren't currently growing. So that's right. The reason the Sun Belt is more interesting to you right now.
Exactly. Yeah, we did an internal study where one of the guys I hired, his hobby is sports analytics, so he could tell you like what stat in college basketball is most correlated with a team winning. And I think he told me, for people curious, it was like actually pace of play and combined with something else and points, and like 3-pointers wasn't wasn't actually correlated at all, even though that's what you think about,
That's what you would think it would be. Yeah.
like Golden State, raining down threes. But anyways, that he made something similar for the largest 40 markets in the country. And what we learned doing that was what's correlated with multifamily price appreciation the most was population growth as a percentage, and then job growth as a percentage, not the raw numbers. Like I hear people say something like, oh, 100 people a day moved to Austin. Like that, you can't do anything with that info. How many moved out, and what is that relative to the overall population there? But so we then made our own, if you will, market analytics model, and that pointed us to the markets we're in today. But they're kind of obvious ones where we invest in Phoenix, Dallas, and Austin now. Yeah.
So net job growth, net population growth.
Yeah. And then also Phoenix has they have the most, I would say, the most favorable property tax laws in the country. If anyone is, I saw someone on Twitter the other day where they tweeted out like, is this actually how it works? It seems like it's too good almost. Where
so what is I'm not familiar with this. What's the advantage?
Yeah, there's a 5% per year increase assessed value cap, even if the property sells. So they have this thing there called it's called Rule A, and it hasn't been in effect for that long, less than 10 years. So not everyone knows about it. Or if you look back and go, what happened with Phoenix in, year 2000 or 2002 apartments, if you look way back, that was under like a different set of property tax laws. So you have a market where the rents grow fast, and the property taxes have a cap on them, on the increase. So even on a sale, so you have a lot of tax certainty where I'm going to buy this property, I'll just underwrite a 5% per year assessed value tax increase, on it every year, and you have certainty. Whereas like in Florida or Texas, some of these other places that are growing, rapidly, there's no cap on taxes or say insurance. And then also in Phoenix, it's nice, insurance is super low because there's not really any natural disasters there.
Right.
So it's just
right. Interesting. I think one of the topics you talked about is basically this idea of focusing on like risk adjusted return. And I think that's what you're hinting at here. This one of the reasons why Arizona, Phoenix specifically, is interesting to you. Can you go into more about that when you talk about thinking about risk adjusted returns?
Yeah. And I think we think about that in all aspects. I remember like 10 years ago. And so like I live in Chicago as of right now, and Sam Zell lives here too, who's, one of arguably the most famous real estate investor, and went to a talk that ULI was doing where he was just chatting with a guy who used to work for him, but now he owns, I think the company's called Cortland something. And so they were chatting and they only talked about risk. It was really interesting. And actually like a lot of the conversation, probably me as like a 25-year-old or whenever I would have gone to that, I didn't really understand a lot of what they were talking about in terms of like, they weren't talking about, oh, hey, this is what's happening in this market, or here's like our upside scenario. They more or less were talking about just as you get into this investing game more, you see all the ways you can get burned, and just they know how to protect themselves from that, or what to at least look for. And then also they know what are like the biggest drivers of the deal. Because I'd say like a lot of new people, like to that point, they might spend a lot of time like, okay, I want to make sure everything is like exactly right in my, with maybe how I underwrote this. And they'll spend more time on making sure the utility assumptions are perfect. Whereas like the main thing that is driving the deal is probably your starting rents and your property taxes, like where those things make such a bigger difference than so they might spend 99% of their time talking about starting rents and property taxes because they know that's going to be the biggest driver of the deal. Whereas like, new people, maybe they're just thinking about that, they don't know where to focus. So that was an interesting conversation I heard about risk, and probably what I see, like whether it's, I guess I see LPs in terms of like maybe a mistake in terms of how they're looking at risk is, let's say, a passive investor. I think they, for the most part, they just, they don't do this every day. So they don't fully understand what risks are all involved. Sure. And so they just end up picking the deal that has the highest returns, I feel like, most of the time. they'll go, okay, we have 2 apartment buildings. One, you buy it, it's a 10-year-old building. It's in, it's in downtown Tempe, Arizona, let's say. And this other deal is in just maybe a weaker market, and you got to renovate it and clear the building out, take construction risk, lease it back up, take all this risk, probably put a permanent loan on it once you're done with your renovation at a interest rate you don't know. But the more risky deal, maybe it makes a couple percent more. Let's say the LP return might be a 15 IRR on a value add deal like that.
Mm-hmm.
And then a stabilized one, maybe it's like a 12. The 15% return deal makes, will raise money better, even though the risk might be, 5 times as much for just a 3% more return. But everyone jumps at the 15% just because it's higher. And then they kind of think, well, they're both apartment deals. How different could they be? And when you do this every day, like, they're a lot different. One, you basically buy it. You don't have to, what your rents are. You can get a permanent loan on day one. It's a newer building. And in the other one, there's like so many moving pieces, and they're not being compensated enough, I don't think, let's say, to take that extra risk just for 3%. So.
Right. And the moving parts, I think, cannot be understated when you're talking about a sponsor, and if they're having to do a value add and do construction. There's a lot of things to get right, and there's a lot of things that can go wrong versus just a kind of a layup deal that maybe has a lower pref, but there's just so many less things that can go wrong. And I think that's your risk adjusted. And it's hard to put a number exactly to those things.
There's not really a metric to look at for the risk. I mean, there is something called the Sharpe ratio and some things, but it's not really, it's not really something where you would use it and be like, this ratio is this, and then I'll take that. Where it's for your average person, they're just looking at it going, okay, this deal makes a 12, this one makes a 15. I'll take the 15. But it's really, the reason I want to point this out, though, is a lot of the people that are, if they don't raise money, and let's say it's they're second generation real estate investors, or they just or they're just, it's their own money. It could be first generation too. That doesn't really matter, I guess. But they're usually buying those safer deals oftentimes because they understand they see all the moving pieces, and they're like, oh, this is like a lot more of a challenge to hit that 15 than just this, as you said, like a layup 12. And then also too, I think if it's all your own money and you're doing all the work, you factor in the workload too, and you're like, geez, this will be a lot of work to do all this for just 3% more, plus sure. Maybe I was wrong on my finished rents and I'll end up doing all this work and still make a 12. So it's interesting because I see that the people who are, they're just investing their own money and doing the work, they're typically choosing that safer deal because a 12% return is still high. If you put that in your retirement calculator and you look at where you'd be making 12% a year, you'd be happy. So you don't need to take on more risk to be at a 15 necessarily.
Right, because the net result to your outcome, 30 years down the road isn't that significant compared to the reality that the 12% or the 15% return is just the target. There's no guarantee you're going to get that.
Right.
I mean, you could only get an 8. You might lose money because there's all these risks that there's the downside risk are so much higher for the slightly incremental upside.
Yeah. And I have a buddy who works at a real estate private equity company, and I think it's a $1 billion fund. And I was getting dinner with him, and he explained how they had invested in a half dozen or so office buildings in this fund, and every single one of them went to zero in terms of their equity, or they bought in Portland, outside of New York City, downtown LA, like where the product types carry different risks. There is a difference. And all those deals, when they started, their pro forma said over a 20% IRR is what they would make. Sure. And so now they're shifting strategies. They're going to do student housing and multifamily. And so that's, and
all those LPs capital is just, they've lost all their capital.
Yeah. That's within a fund. And they, that probably was like 1/8 of the fund. So it's still possible they can dig out of that. And then
Yeah,
that also was, all institutional equity. So I don't think there are any people, just
there weren't,
individuals in that.
yeah, people's IRAs tied up in this. Yeah.
Well, actually, a lot of their investors are pension funds. So no, it was,
Oh.
no, there's definitely some retirement money in there. But that's, so that's something I had figured out, where I know you had mentioned we want to talk about multifamily, that,
Mhm.
I had bought an office building in 2009.
Mhm.
And I was, as we owned it, I was shocked at how much money you need to put back into the property. Because, up to that point, I had owned just apartments and had bought 2 shopping centers earlier that year.
Mhm.
But office, you have a tenant leave, and then you got to pay your leasing broker, the tenant's leasing broker, give them free rent, build out the space pretty much for them, and give them a tenant allowance, which is just just giving them more money to help finish their build out.
Sure.
So yeah, I learned, office and some of these commercial product types. It was really lumpy in terms of the what kind of net, we'll call it, what your cash flow actually would be, because you got to add a lot of money back when you have a big lease renewal, or a tenant leave and have to re-rent it.
Yeah, and the vacancy rates of commercial, it just seems like they could be terrible compared to the vacancy rates that you would see in apartment complexes, which certainly can happen, and bad things can happen to apartments too. But it seems like the risk profile is just completely different.
Yeah, it's those product types, retail, office. This would not be the case for industrial anymore, but for sure, retail and industrial, those are, retail and office. Those are just perpetually tenants markets where, if you looked up what's the occupancy nationwide on those, it's probably in the 80s. So you just always have like a soft market where the tenants have a ton of options and the upper hand. Whereas in, multifamily, it's the opposite, where
Completely opposite.
depending on where you are in the country, that market will be 90% to, 99% occupied. And you have, it's either balanced where it's, equal between landlord and tenant, or the landlord, you could say, has the upper hand. Definitely has the last few years, obviously, with how much rents have grown. So it's a lot more balanced now. Obviously.
Yeah. So let's switch then to the conversation of multifamily, and what are the stakes in the ground. Like, this is the reason why multifamily has become your discipline that you're going to go in.
Yeah. So same person that I had calculate that, make our market model. We got our hands on some NCREIF data, and NCREIF is a trade group.
Okay.
Forgot what it stands for, but they have an index that represents private real estate values. And so what we calculated, it was from 1990 to 2000. We had 2020, we had the data. So 30 years.
Wow.
And then we measured all the possible return scenarios. So for different hold periods, for 3-year, 5-year, 7 and 10-year hold periods for the 4 major product types. So retail, industrial, office, multifamily. And in every scenario, multifamily had the highest returns, and it had the lowest risk, using that Sharpe ratio metric.
Wow.
In every scenario, except I think retail or industrial, and one of them had lower risk but lower returns. So basically every scenario, multifamily on that was the best, going back since 1990, which it always felt like that, but it, I never had the actual data. And then you think about it, instead of, your office building where there might be 2 or 3 businesses in there, in an apartment building, you have a diversified, pool of tenants where they all make places that, for the most part, they'll be working at different places. And so they're making money from different companies. Some of these deals we have, there's, 200 people living in them. And so you have, instead of a couple tenants, you have, many, could be dozens, could be hundreds. And then you have all the tailwinds where, just like we were talking about, it's actually usually a landlord market in terms of the occupancy, where you're in the 90s. And then you're benefiting from all the population trends where you have, Gen Z just finally now getting into the rental market, and that's 1/3 of the population. And then you have the existing renters, they're renting longer, so, people that, whatever, are 30 years old now, a lot of times they would have already bought, they're renting either by choice, or, homes are so expensive now, that, they're just choosing to continue. They're not able to choose to continue rent. They're, unfortunately forced to. So you have all those, tailwinds behind you. Plus the lease term is really nice, being 1 year, where another negative with commercial, like these last few years where inflation was running, 8% or whatever, you could be locked into a 2% per year increase in your commercial lease. And whereas if you were in apartments, at the end of the year, you could have, bopped it to whatever the rent should have been. So that's nice for resetting your rents, but it's also nice to have a year compared to like a hotel where you got to re-rent it literally every day. Where if you have something like, like the pandemic or whatever happens, then you got, no one shows up the next day. So, those are all things we like. Plus, it has the best debt availability. So if you think about it, right now for basically all the time, the largest lender in the multifamily market is Fannie, Freddie, and HUD. So, and those aren't available to other product types. So that's a huge, at a time like right now where if you had an office building, retail, industrial, it's really hard to get any financing. And everyone I know in multifamily, they're doing all these, Freddie floaters, Fannie, 10-year fixed, and they have a lot of options, but they don't realize like that's only on apartments. They're just kind of already doing them. So yeah, best debt, tailwinds, highest returns. Plus also, it's inexpensive to re-rent the space. So just like I had talked about where, in office where you could be given back, years of rent to re-rent the space, in apartments, you paint and clean it. Some markets you might have to pay like a leasing commission, leasing bonus. It might be vacant for a little bit, but it's, inexpensive compared to those other product types.
Okay. And so Breneman Capital is your company, and it's now focused on multifamily and the completely dropped the ball.
Phoenix, Dallas, and Austin.
Yeah, Phoenix, Dallas, and Austin are your markets. Okay. Is that set up as a fund, or are you doing these on a per deal basis?
Deal by deal.
Okay. So you're doing a syndication per deal. Walk us through your strategy how are you finding these deals? How are you building your capital stack? And kind of who are the major players? Are you the asset manager? Are you the property manager, et cetera?
Yeah. I mean, in terms of the, what are we doing where we haven't, partnered with anybody to operate the deal. So yeah, we do every piece of it from acquire it to the asset management. But yeah, so we find the deals. 80% of the properties I bought to date have been either off market or off market with a broker or from a repeat seller. So I spent a lot of time like focusing on being easy to work with as a buyer, not just like letting people walk all over you, but being, not making issues out of things that aren't, shouldn't be like a big deal. Having a smooth closing for the broker. One of the deals we bought in Phoenix, I remember I was joking with the broker when we closed, like, sorry, there wasn't anything for you to do on this one. Maybe we'll have some drama around the next one, because there was literally nothing. Like there was almost no conversation the whole time. We just put it under contract and then we bought it, where there was almost nothing to,
which is unheard
to do.
of. Which is unheard of. And, I mean, for those of you who don't know, some of you who aren't experienced in multifamily commercial space, like brokers get beat up hard in this space. Like they have to put out fires constantly. Yeah,
and so we know that, and we're not letting people just like walk all over us where there wasn't. But also that was a building we were going to buy and renovate. So if we saw like a little thing wrong with the unit, doesn't matter. We're probably ripping that out anyways.
Sure.
So, and I'd rather have see his next deal and get some off market looks than, be nickel and diming him over his commission, or, asking the seller to chip in $5,000 or something, and so, yeah, so that's, we've focused on, sourcing deals that way. We haven't done any I don't think we've done enough direct to seller outreach. That's something I'd like to start, where, I get calls all the time, people saying, hey, I'm calling about your property at, blah, blah, blah. And, usually I don't call them back, but I mean that, I think right now, the investment market is slow. It's hard to make deals make financial sense right now, but that could change pretty quick. A couple things change where rents start going up a lot or interest rates drop, and all of a sudden things will make sense again. And then you would have been maybe the only person that's owner talked to, and then you're top of mind when it's time to sell again. So,
and how are you building your capital stack, or where are you getting your lending and your equity?
Yeah. So equity for, probably the first, call it, first 3 years was just my own money. Then I picked up an investor, then another. But, for those first 10 or so years, I really was only set up to and work with those two investors, because we built the company together. So we weren't set up to, do a syndication, because, there's more work that goes into it. Let's say you have, 20, 30 investors in a deal, you need to pass out K1s to everyone. You need to make quarterly reporting. You need to have a way to calculate everyone's distribution. Where if you just have one partner in the deal, you don't really need to do any of that, because they already know what's going on. Yeah. Yeah. And then one of them, actually, on both, their daughters ended up being working as our, doing our accounting, just where they have both been really good, but they, also saw what we were doing. Like, hey, this looks better than my current job. Let me come over here. And we needed someone anyways. And, it's great to have someone like that you can trust. So that, so then in 2020, I'm like, I need to solve this. I want to, start having other people come in these deals. Like, we did really well on these deals that we had bought, and I saw like what an impact that made for them and for me. Like, we and wanted to kind of open it up, because also I had people over that period of time come to me saying, I have 50 grand or 100,000. Like, I have what is to me like a lot of money. Like, my parents were just both teachers, so like if they for them to put in 50 grand and something would be like a lot of money for them. And so I always thought, like, these are still serious investors, but I didn't have an avenue to kind of have it be like a good experience for them. So I didn't take any of the money. But not now we do. So yeah, every deal now would be a syndication. Sometimes we'll, since also we might sell a deal we've owned for a while and do a 1031 into it. And then we would just usually do that with the existing equity. So that would be our two equity sources, just, every day, accredited investors that want to invest in a syndication. And then, maybe like a legacy deal we're selling and then rolling into a bigger one.
Yeah, I'm looking forward to those days when I can cash out and roll exchange the deals that I'm exiting into the next one. That'll just make everything a lot easier. Yeah,
I have one. We've been very long-term investors. Some of these, like that first deal I bought with that first investor, we still own. We've owned it for almost 14 years now.
Oh wow!
And we had that office building I was talking about. We sold that after owning it for 5 years. We doubled our money on it. Then we did a 1031 into a larger shopping center. We doubled our money on that deal. This is both over about 5-year holds. And then we traded into 2 shopping centers from there. And we started out with the first building we bought. We put $930,000 down, bought it for $4.4 million. And those 2 shopping centers we own now together are worth about $17 million. At least that's what we paid. They're worth more now, and our cash flow on that plus the loan pay down. So just saying, like, they are appreciating, but don't even factor that in yet. It's $800,000 a year cash flow plus the loan pay down. So if you think about that, it's like almost 100% return on that 930.
Yeah.
Like per year, and so that's obviously not how, like IRR is calculated or anything, but that's long-term investing in real estate can be really powerful. And so we've done that on a lot of those deals, just where, it's great to make high IRRs for a year or whatever, but, to really build wealth, like it's done over the long haul and, focusing maybe more on equity multiple than IRR. Because too, if you think about like these or you want to jump in?
No, continue.
I have
a question, but keep going. Yeah.
Yeah, you think about these families in like Chicago or New York that made money in real estate. The Vanderbilts, Rockefeller, like they didn't buy a deal for a year and then there wasn't LinkedIn, but go on LinkedIn and say we made an 80% IRR. No, they just bought it in like 1935 and they still own it. And they it's gone up 100x. So that's
it's all house money. I mean, they're just playing with house money over and over again. Yeah.
Yeah, so we're doing our version of that on some deals. It's harder to do that in a syndication, where I think they're looking for that to come back at some point. But we're usually not showing like a, like that short of a hold. Probably our average deal as we present like a 5 or 7 year hold.
5 to 7 year hold, yeah. And are you looking to opportunities where you can recapitalize an existing project where you can basically buy out your LPs?
No, we haven't. I think that's tricky as a sponsor, where to make everyone, personally, my worry is like one side thinks they got a bad deal, where to truly know the value and get, your the payout, is like you could sell to a third party would be ideal. So I'd be worried, like partner one gets bought out by partner two, and then something happens. If the deal goes poorly, then partner, two will think, oh, you knew this thing was gonna, if something was gonna happen, then you could swap me in, and vice versa. Like the market shoots up, and then your original partner thinks you're supposed to predict what happened in the market. So no, I haven't, almost just because I'm worried more for like relationship issues versus like
no, I can see that.
Whether I think it's a good idea or not. One thing we have done, if this is helpful for people, I mean, in terms of the deal types we've been doing, like we normally we're buying closer to that like newer, nicer stuff I was talking about with the, example of like what LPs. And we have we've done a lot of loan assumption deals on very new properties where right now the benefit of a loan assumption, and for those maybe who don't know, like on commercial properties, you generally always have some sort of prepayment penalty. So you can't just pay off the loan for free like you can with like a residential home loan.
Right.
So, sometimes it's like a prepay that's pretty small, where maybe it's 1% at the end of your loan amount. And that's not like a big deal. You'll sell the property, they'll pay. But a lot of these properties, they have yield maintenance is the term for it. And so those types of prepayment penalties, especially in 2020, when I think we did 3 that year, when rates were below the new interest rates, if you were to put a new loan on, were below the old rates on these loans, you had to pay a huge fee to get out of those because the lender wanted their, yield maintained. Right. So either going, okay, this loan's at 4.5% interest, you'll pay me off, but then, the new loans are going to be in the 3s. So there's like a very complicated calculation to figure out what is owed. But to keep it simple, on a lot of those deals, it was like 10 to 20% of the loan balance would have been the fee.
Whoa.
And we're not looking at, that small of deals. Like on one, it would have, both of these, it would have been all these, it would have been a few $1 million.
Sure.
So on all of them, we were the only bidder, and we assumed their loan, and we just, here's where it works for us. Let us know if you'll do it. And on 2 of them, it was someone I'd already had transacted with. So they knew we were closers, and knew we had already done like a 20-some agency loans with Freddie or Fannie, and that's what they had. Yeah. So they thought of us, and then we closed, and we wrote our own ticket, basically price wise. And also funny how things changed. The discount was because that rate was so high. It was, both were around 4.5% interest, which now today, yeah. Yeah. And then today, loan assumptions aren't bad either, because you'd be assuming the loan probably 4.5%, 3%, something. So we've been looking at, continuing to do that, because then that makes sense, where you can, make sense of a deal if you can get yesterday's interest rate still.
Yeah, I think it makes a lot of sense to do loan assumptions now. If it's possible, it makes good sense to do it, because there are a lot of people that are in a situation where their loan's about to recast on them, and they just didn't factor in their cash flows to account for the new interest rates. And I mean, they're in a pickle, and somebody else who is better. Go ahead.
Yeah, those deals you probably, you're going to want to maybe buy and put a different loan on, that's where they got themselves into trouble. But you're right. That's a good buying opportunity potentially, because you have, pretty as close as you get to a forced seller these days, where they're going to have to add money, or it's either it's cash flow negative, or do a cash in refinance and pay the loan down if they want to get a new one.
Yeah. That's what I thought. It's like you buy into it and you pay it down. Yeah.
Yeah.
Okay. So we're throwing a lot of lingo out here. So maybe let's take a step back, because I've only I'm still relatively new at this, and I'm still just thinking about these chess moves. And a lot of the people listening here are more likely to be new sponsors, or they're interested in being an LP. How can someone break into this business? You've been doing it since you were 19 years old. You have a pedigree, kind of the way you broke into the business. Some of us don't have that advantage or that insight. What's something you can share with us?
Yeah, and they want to break in as a sponsor or buy your own deals.
Sure.
You're saying? Yeah. Well, I mean, in terms of it's almost funny to hear someone say that I have a pedigree now at this point. But like I said, my parents are both teachers. I'm from Milwaukee. I mean, I didn't have any advantage in terms of like, I just like walked into like I had like a cousin or someone who was already in real estate and could be like, hey,
Right.
here's how to do it. So no, I think the way I started, really anybody could do it. It wasn't easy at all, though. It was, I was able to make some money with my business, but you could have done that in a job. I saved it all. I didn't spend any of it. I kept it all. And then I used it to buy my first rental properties. And in terms of like getting started, and I lived in cheap places until I was, in my late 20s. I had, just kept building the snowball. Even when I was like a partner in, it would have been $25 million of deals by 2012. And I was living in a place that cost less than $1,000 a month. And then when I quit my full-time job, just to extend my runway longer, I could, didn't need to worry about bringing in or spending my own money. I moved in with my parents for a year. So, which, and that would have been when I was 26, and that's not what a 26-year-old wants to do. Sure. But I was okay making those sacrifices. And I think so you're going to have to, put in the work and make sacrifices. And then, I educated myself, but I didn't like overdo it. Like I read probably 1 or 2 books on real estate investing, and then I just went out and bought my first deal. Yeah. I focused on things that, I thought were the main, really the main elements, and just kind of didn't want to get bogged down with the little stuff to begin with, where in retrospect, that ended up being a good plan, because I focused just on how do they value these buildings, and it was gross rent multiplier. So I made sure I understood like how people were using that in Madison, Wisconsin. And then I focused on buying a cash flow positive deal, because I figured that you like these people who, if you want to break in and how to be like just go from zero to like some sponsor who's syndicating deals and doing renovations in another state. I don't know how you can just jump into that, from like scratch. Like I started with a duplex and just kind of baby stepped up into that, and also with my own money. So then like my thought was I could totally overpay for this thing. I could maybe have no clue what I'm doing. But if it's cash flow positive, worst case, I just hold it, and I'm cash flowing money every month, paying the loan down, and I just need to wait to dig out of the hole I would have put myself in if I overpaid. Sure. Thankfully, I didn't overpay. And then also I assumed the rents and expenses right. So it was cash flow positive. I bought it right. It ended up, everything went well in the deal. But that's how I kind of, just to keep it like very simple, I'd say start with that. Just go save up your own money, buy a cash flow positive deal.
And then don't ladder yourself up.
Yeah. Then the next property I bought was a 2-unit. Then I bought a 3-unit, another 3-unit. Like I did have different jump ups into bigger stuff, but it was, these, sometimes I see somebody get started, it's their first deal, and they bought like a 30-unit, and I'm shocked how they do that. I don't know exactly the best way to do that. So it's,
So as we wrap up here, I'd like to give you a chance to let everybody know how to get a hold of you. So you're out here, you're on the podcast circuit. What is your mission and why you're out here doing this? And then after you answer that, how can people find you?
Yeah, I think, I'd like to, teach others about real estate. I have a podcast. It's called the Breneman Blueprint. And I think, like I said, like some of this, you hear so much stuff talked about, but like I did an episode on doing your first deal, and it's more or less the same message I just said. It's actually like pretty simple. And the episode is probably pretty short, where you don't need to overcomplicate it. So yeah, I mean, my parents are both teachers. Like I said, I want to try my hand at, doing some, free education here and see how that would go. And so yeah, so I started the Breneman Blueprint. I think we're at like 50 or 60 episodes I have to check. So it's been, it's been fun, and a lot, I've learned a lot doing it, having guests on and everything. And then too, like, keep going.
Go ahead.
Oh yeah, I was going to say, and then same thing with, for Breneman Capital, where I would be I had potential LPs come to me, but then they wouldn't, wasn't able to take them on. So I was happy I was able to solve that problem. We also wrote a passive investing guidebook where it's 100 pages, free PDF download. It's on our website, breneman.com. I think just like /downloads, or go click downloads. But and that explains all the terms. We used a lot of jargon here, all the terms and different things that you would want to that you could read through and learn about for passive investing. So that's, investing in other people's deals where you don't need to do the work yourself. You're
Right.
just investing and signing your name. And they, and also too, like there's a big section on risks too. So, all the different types of risks to think about, because I kind of just said there's a lot of risk in this, but it lists it out like there's risk to the debt, there's risk, with the sponsor you pick, the product type, the business plan, where it goes through all that and how to think about it.
Mm-hmm.
So that's all there. And then, if anyone wants to get on our investor list, you can just go to breneman.com and there's a invest now button in the upper right corner. Click that. And then you're just on a list. So then you get sent the deals. And if you like it, you can, when they're available, say how much you want to invest. So it doesn't.
Yeah, it makes sense to look at a lot of deals when you're getting started, just to get a sense of the lingo and what people are doing. And I've learned a lot just by being on people's list and getting access to deals to invest as an LP. I think that's a really smart way to get going. And then you can try your hand at being a GP on your own project or co-sponsor with somebody else if you want to.
Yeah. And I've learned a lot from observing others too. So it's interesting you say that, where I've not, just seeing other people's deals, how they present them, what they buy, what they're doing, what their business plan is. I've learned a lot from that too.
Same. Yeah.
It's a good tip.
It's what's interesting about this is when you start looking at all these pitch decks and all these multifamily projects, I mean, it's the same stuff over and over again. And you start to see how simple the business really becomes, because once you solve a couple of concepts, it's like, this is actually pretty down to earth. I mean, it's like, qualifying for the loans and getting the capital stack built and understanding the syndication process, I think is probably the hardest part, and getting your head around all the moving parts. But once you get that figured out, like, owning an apartment complex and renting it, it's not rocket science.
Yeah, no, I agree. When you see these people that are successful in this business, a lot of times it's not like, oh, they went to Harvard like for undergrad and MBA. It's like the opposite. It's like, no, they're just a regular person and they just took a chance and just kind of just kept, I think like you said, laddering up like into bigger deals. And then you see them when they're like 50 and you're like, oh, wow, this guy buys 200 unit buildings, but that's not how he started.
That's not how he started.
Yeah.
Sure. Yeah. Well, I appreciate your time today, Drew. This has been super helpful, super interesting. And I'll make sure and put all the links and the resources that you mentioned in the show notes, and make sure everybody go out there and grab that passive investment resource. I think that'd be a really good primer from somebody who's been doing it for a long time. And Drew, thanks so much. And for everybody listening to this, here's to you leading life completely by design.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcasts. Dive deeper into real estate investing on Breneman Capital's website, breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording, and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.